Hi, everyone, and welcome to this month's special Investors Business Daily installment of Barron's Live. I'm Coram, Executive Editor, Multimedia at IBD, and I'm joined by my colleague, David Saito-Chung. He's Deputy Markets Editor at Investors Business Daily. Thanks for joining me today, Dave.
Hey, thank you, Ali. This is my third time this year on Barron's Live, so happy to complete our so-called hat trick for 2023.
Same here. And I'm excited about today's discussion where we are going to be talking about how to find the next 10 bagger stocks. How can we find those stocks that are going to go up tenfold? And that outperformance, that's what we want without having to make too many buys and sells, right? I mean, sign me up for that. And while holding a stock for a tenfold move is rare, it's not impossible. So, we're going to detail how investors can find these seemingly elusive trades and how to determine which stocks are the ones that deserve your patience. So, Dave, just want your opening thoughts on how we find these hidden gem mega winners. They're out there.
They certainly are, Ali, and I I'm not going to guarantee that we're going to hit all stocks that are going to make 10 baggers, but if some of them make a three bag or a five bagger move, I hope the audience won't be too upset, right? Those are
I don't think so.
no those
I think those
gains
are
would.
still big gains.
That's right. And we're not talking about stocks that go from $1 a share to $10 a share. We're talking about highly priced stocks that are institutional favorites and are growing really amazingly in the revenue and and their earnings, and are really influencing the way we live, work, and play. So we're going to hit some principles that I've come up with, as well as show a couple past examples, and then look to some IBD screens that highlight a few current companies that we feel strongly that have the potential to do that kind of move.
Exactly. So let's get into it. You talked about institutional quality. These are names we know, and we'll take a look at some historical examples. But what
hmm
do you think is the key to finding it's a mix, I think, of a quality, but also something that has longevity as well as these aren't flash in the pan kind of stocks.
That's right. I think one of the key principles we'll talk about is the patience factor, being willing to let the stock go on its multi-year incredible journey of gains, and that doesn't happen without a sustained buying by mutual funds and pension funds, sovereign wealth funds, and the like. It's not our friendly neighbor down the street that's buying the shares and pushing the stock up tenfold. It really is the participation of big institutional investors. So we like to look at stock charts to determine that, and we're going to look at a few monthly charts that indicate the sort of footprints that are being left by institutions. We're also going to really focus on those companies that we really can understand and know. All of us listening in have a specific knowledge base and experience with various different companies and different industries. I would highlight that you, first of all, really focus on your own circle of expertise, invest in the sort of industries and companies you know. You don't have to try to take on a brand new industry that's foreign to you and try to find the big winner there. Focus on companies that you feel comfortable that have a really strong future.
Yeah. And I think that conviction is especially important because it's not going to be easy to hold a stock that goes up tenfold. Traders are
That's right.
going to be tested, right?
hmm
Tested through bear markets or different economic factors that can weigh on stocks, whether it's stock related, sector related, or market related. There's going to be these tests.
Oh, so true. You use the word test in IBD and on our shows and in stories. We use the word correction when a stock market gets a little too hot and overheats. We're going to have a decline. And here's a really important fact to know: the top growth stocks tend to fall 1.5 to 2.5 times whatever the S&P or the Nasdaq does. So when you have a true bear market, expect the top stocks to fall 40, 50, even 60% or more. And that happens. Some of them do come back, however. We also really stress the importance of waiting for good market conditions. And That requires a little bit of reading and watching the market, and that's what IBD is all about. We want people to, once they enter the market, enter at the best possible time to increase their probabilities of finding those 10 baggers.
Hmm. And so timing is everything.
Hmm.
Traders who maybe bought some of the quality stocks when the market topped. I mean, could you imagine holding those all the way down? I'm sure some traders have done that. So we're not talking about having conviction no matter what, and you're holding something that goes down 70% because you think eventually in 5, 10, 20 years, it's going to be a big winner. So there is that timing element as well. And that makes it easier to hold. If you're coming from a position of strength and
Hmm.
you're up on a stock, seeing some of those drawdowns is easier to stomach.
Oh, totally. I think you raise some really important points. We're not trying to approach this from a value investing angle. We're not trying to help teach our listeners how to be the next Warren Buffett. Warren Buffett does his homework. He looks for value in the market, looking for great durable companies that are priced well below their intrinsic value. We're talking about stocks that might be seen as overly priced, right? That seem to be well above their so-called intrinsic financial statement value. But we feel you're in a better position of strength as an individual investor when you first make that initial investment and it's making money for you. You're getting upside progress, and then only then do you actually add more of your valuable capital to a winning name. We highly advise against buying stocks on the way down. We like to say that's throwing good money after bad. So, in order to avoid that, first of all, don't try to buy on dips in high growth stocks. And two, don't try to buy into a downtrend.
Yeah. And I love this question from Brian submitted ahead of time saying, I am happy to go through several hundred charts, but going through 9,000 stock charts, I don't have time for that. So let's whittle the field down a little bit of finding these 10 bagger starts. So let's start with the fundamental side. What
Okay,
are we looking for the fundamentals for these quality cream of the crop stocks?
great question. And let me first start out by saying that I've created screens on MarketSmith. We also have excellent screens on investors.com, whether it's IBD 50, Big Cap 20, or sector leaders that look at short and long term earnings per share growth on a year over year basis, plus look at sales, profit margins, and return on equity. I've been with IBD for over 20 years, and I've got that great opportunity to really do research on the past big winners like Cisco in the 90s, like Microsoft, which initially broke out back in late 1986 and survived the Black Monday crash of 87 and went on to become, a superstar stock, and Apple, of course. And the common thread, Ali, among these companies is one, the 3 to 5 year earnings per share growth rate was at least 30%. Two, the return on equity was greater than 25%. The founder of IBD and longtime chairman William O'Neill, who passed on May 30th this year, he set a rule saying, at minimum, you should be looking at companies with a return on equity, which is a measure of profitability of at least 17%. Well, I've seen in strong bull markets that a lot of companies actually are showing 17% ROE or higher. So I'm looking for even the real creme de la creme. Look for those that have a net income versus equity of 25% or more. Finally, sales growth. We simplify that by using the sales and margins and return on equity rating, the SMR. And a recent screen that I ran, looking for those future Cisco's, Home Depots, and Microsofts, uh, they're going to have an SMR rating of A or B on a scale of A to E. We're not going to talk about these four stocks in detail today, but a few did make the screen, and they included ServiceNow, NOW, which is a IBD leaderboard stock, Zscaler, which is a leader in cybersecurity, that ticker is ZS, Kinsale Capital, which is an insurance company that focuses on specialty insurance, KNSL, and CrowdStrike, CRWD, another cybersecurity name Just for full disclosure, I do own shares in ServiceNow because I'm also an active investor, not just simply a journalist. We're going to
Mhm.
cover similar names, but anyway, only four names made this very strict screen for fundamentals, and then we're also looking for really strong relative strength, which we'll go into through the charts.
Yeah, some good names for the watch list there. And I too own Service now. I love that RS line leading as it was forming the right side of the base. But let's talk about, speaking of chart patterns,
Hmm.
when's the right time to be buying these potential five baggers and 10 baggers? Because if we have the market trend on our side, that's a big ingredient. But it sounds like we're looking for stocks in the earlier stages of their moves
Hmm.
rather than perhaps ones that have been running, although maybe strength begets strength. But how do you think about timing buys to hold these stocks for big moves? And speaking of, I do just want to mention that Dave, you've been doing this a lot longer than I have. I've been with IBD about 9 years, and I'm on the hunt for my first, 5 and 10 bagger stocks. But you have been able to hold stocks for some really big gains over the long run. So you definitely bring that time tested expertise to today's discussion.
Well, when we look at the past 10 years, for instance, you go back to 2013, that was several years after the bottom of the great financial crisis, right? And we've seen a lot of growth in the economy and a lot of growth in technology and innovation, and plus retail companies too that have done well. In terms of the timing, as you said, we're looking for stocks that have shown some bottoming action in terms of price, are showing evidence that volume is increasing on the way up in price and not on the way down. That's our signal that institutions are buying stocks. And one critical thing that I think often gets forgotten, Ali, is that before we actually locate a particular buy point, whether it's at $40 a share or $400 a share, first you're looking for the stock to have a prior uptrend of at least 30%, then cool off, digest those gains. We call that digestion of the gains a base. It could be in the form of a flat base where the stock doesn't really give up much ground, no more than 10 or 15% off the high. It could form a double bottom with two lows in the pattern, or a cup with handle. There are in fact, seven key chart patterns that we look for and identify on a daily basis through columns like Stock Market Today, through the IBD live show, and through webinars. So that if you spend that little extra time using charts and making charts your friend and not the enemy, so to speak, then I think that will help improve your timing. And keep in mind too, these are stocks that already have proven they have great fundamentals and they have really good outlooks going forward. So it's really a combination of fundamentals and technicals, and then respecting what the institutional investors are doing.
Yeah, great points there, Dave. I mean, trying to pick a bottom in a stock is very difficult, if not impossible. So, seeing stocks that are trending higher and digesting those gains is definitely key there. What would you say is the average holding period for some of these 5 and 10 bagger stocks?
Hmm.
GameStop was a crazy meme stock going crazy, but that's not the kind of thing that we're talking about here. This isn't going to happen overnight, and it requires a lot of patience.
That's right. For sure, there are likely a number of people listening in here who have done very well in a game stock or a meme stock because he or she has that talent for spotting a big, fast money move, if you will, over a shorter period of time. And I do believe that 2021, the year of meme stocks was exceptional, rare. I wouldn't count on it happening year over year. When will the next time be? We don't know. And so, therefore, what the market has rewarded is those more patient investors who have a good timing in their buy in companies that have a record of growth, excellent execution and management, have new products coming down the pipe, and are leaders. This one thing I also wanted to mention: if you want those 5 to 10 baggers, you know, think of the market as an oyster. You want to go for the pearl, right? Don't settle for the shell. In other words, go for the number one company in that industry, and hopefully it's a dynamic industry. Uh, another point that I'd like to make is that in terms of long term, how long do you need to hold these? As an example, Amazon, a stock in an account that I've managed for over the years, it had a nice breakout in 2016. It's gone up 560%. So not quite a 10 bagger yet. And what's amazing is that obviously from 1999 until 2016, it had a hundredfold plus move. Amazing, amazing run, and has changed a lot of industries, right? However, over 7 years, when you consider a five-fold move, you're talking about a compounded annual growth rate in the stock of 30, 40, 50%. Now, think of it this way too. If you find a company that is really, really hot, and if it doubles in 1 year and then doubles again, right, from 100 to 200, 200 to 400, that's a fourfold move, right? That's a 300% move, fourfold move in 2 years. That 100% growth, CAGR, will get you there, obviously, to a 10 bagger in less time than a stock that goes up 30 to 40%, like what we saw in Home Depot and Microsoft in the past. So my general thinking is that if you've got a stock that can really, really rally 100% a year, 3 years in a row, you're going to get to close to a 10 bagger in 3 to 4 years. Otherwise, think 5, 7, 8 years, or maybe a little bit longer.
Well, either way, whether it's 3 years or 8 years, that's still pretty impressive that those opportunities do exist out there. So before we look at some current potential 10 bagger stocks, let's take a look at history, because I think there's a lot that we can learn from some of the best stocks in the past. So, Dave, I would love to start with Home Depot, which you
Yeah.
mentioned. So, we're going back in time here, back to the 80s.
Yes.
And for those just listening in and not looking at the video version, we're showing a monthly chart here of Home Depot.
Mhm.
I have an end date around November of 1993. So, we've gone back 30 years. And if you look at this impressive move from the mid 80s to the early 90s, it went from around, let's see here. Where do we want to start, Dave? I mean, if you got in really early in 87,
That's
at
right.
225 up to 50, that's
Split
a,
adjusted,
yeah,
remember, right?
exactly.
Yes.
I was about to
And
say split
yeah,
adjusted. That's a huge move.
yeah, and this is a great chart to look at, and if you're just listening in, hopefully after the show, you can check out a long-term chart on your favorite chart service later on HD. Let me give you a few details here. First of all, company founded in 1978, and then it went public. There were 5 men who co-founded the company, the most famous of which were Ken Langone, Arthur Blank, and Bernie Marcus. Bernie Marcus and Arthur Blank went on to become executives for a very long time. So founded in 1978, you don't see that on a chart. You don't also see the fact that the IPO was in September 22nd, 1981. Home Depot at the time raised $4.1 million for that IPO. And now, Ali, it's a $306 billion company in market value. You know what? Do you want to guess what that CAGR would be in growth over that 42-year period?
Wow. What was it?
It was 30.6%. And this is the first time I'm going to show a prop in one of these Barron's lives. But this is my one of my favorite devices for analysis. This is a Texas Instruments business analyst calculator, which allows me to figure out CAGR, compounded annual growth
Mhm.
rates. If I have the starting price or the ending price, I have the growth rate, or I have the number of years. I can figure out what those are. So
You're bringing me
this is
back to
actually.
college, Dave.
I got this. I never used one in college, but I wish I started doing that way back when. This is the second one I've actually bought, the BA2 Plus Texas Instruments.
Mhm.
The other one
Classic.
just
Classic.
stopped working, and the some of the keys wore out. But anyway, 30.6% CAGR from the IPO in 1981 until today. And obviously, there have been some big hiccups in the stock, as you see, especially during the Black Monday crash of October 1987. Home Depot fell 57% during that correction. So obviously, it would have been very, very hard to have
Hold
bought
that.
and
Yeah,
held that stock then. So
absolutely.
we're actually going to focus on the breakout that first initially happened in November of 1988. Uh, I know some of you don't have a chart in front of you, so just imagine that the stock had moved sideways for a little bit, 6-week flat base that built on top of a longer base. That breakout happened to be at around $30 a share, and then the breakout had some fits and starts, never quite broke the never triggered that 7% loss cutting sell rule. It actually held okay, and then it really took off in early '89. And I want to explain one reason why from 1989 it went on to have such an amazing move, as you can see on that chart. Uh, at the end of calendar year 1989, their fiscal year ends in January. They had 118 retail warehouse stores. Can imagine how many thousands they have around the world now. And earnings per share at that time, $1.42 per share, $1.42. That was up tenfold um, over the prior 8-9 years. So in other words, that earnings per share was growing at a compounded growth rate of 78%. Revenue was at 2.8 billion in fiscal '89. It grew 300% in 4 years, basically quadrupled in revenue, 41% CAGR. So let me correct myself. That earnings per share was up tenfold in not just 10 years or 9 years. It was up tenfold in 4 years. So for that reason, this company was a rock star, truly. 78% earnings per share growth year over year over 4 years. This is one of the reasons why the institutional crowd really crowded into this stock.
Yeah. So, how do you then handle a breakout? And like you said, some fits and starts when it was
Right.
trying to take off. Maybe, it didn't trigger our ultimate sell rule in terms of managing risk. We did get a question from Marty who's saying, what is your risk control methodology? Well, one aspect is position sizing.
Yes.
At IBD, we do like concentrated positions, maybe 10 stocks or 20 stocks in the portfolio, or on the other end of the spectrum, if you're really getting more concentrated, maybe even fewer positions. But the key to risk management is your loss cutting rules and not taking on big losses. Dave, can you touch on that?
Totally. Yeah, let's talk about this briefly. First off, the golden rule, as I like to talk about it in terms of IBD methodology, is to cut your losses short, no more than 7%. When Bill O'Neill met Gerald Loeb, the famous stock market investor and broker who wrote many great books, and asked Gerald Loeb in his office, what do you think about cutting losses at 7-8%? Because he got that idea from Gerald Loeb's book, The Battle for Investment Survival. Keep your losses at 10%. And what Gerald Loeb told Bill O'Neill was that uh, I'd much prefer to get out of my losing stocks more quickly than 10%. I prefer much, much smaller. So as a result, Bill would cut his losses in general 4 to 5%. If you
Mhm.
cut your losses at 7%, it only requires a 7.1 or 7.2% gain in your next trade to get to break even. So much easier on your mental health and psychology than
Digging a
uh,
hole,
digging
digging
a
a big
hole.
hole. Yeah.
Exactly, like with a 20 or 30 or 50% drop, right? Like if you invest 10 grand and you lose 5 grand, you need a double on your next in your next investment to go from 5 grand back to 10 grand. So that's the very, very important mathematics of trading and investing in the stock market. Now, also, if you get out of the stock too early, as I always like to say to friends and colleagues and on shows, if the stock really is a great stock and you have the conviction that it could become a big winner, just shake it off, buy it back, and buy it back when the market is in better shape and the stock is in better shape. And the market will never know and it will never care. It's there's nothing wrong with buying back a stock, especially with the advantage of liquidity in the stock market versus say private equity or you know forestry or buying timberland or something like that. So it's very important to realize that as individual investors, you have that advantage of correcting your past errors or your past transactions, and you realize, okay, I was right in the stock, but I should have bought more. Well, you look then for new bases to form, as we see here on Home Depot's chart. You can see those red bars that indicate monthly declines. Well, you zoom in on a daily chart, you're probably going to spot a base after that prior uptrend of at least 30%. Maybe the stock only fell 15, 20%. Maybe it formed a base on base. Maybe the market was also falling 20 to 25%. If your stock is also falling only 20 to 25% during a bear market, that is a sign of strength in the stock because the stock doesn't necessarily have to rebound as much to get back to a possible new high and a breakout. So,
Mhm.
all in all, Ellie, you don't have to bet the ranch on that very first initial move by the
Right.
stock. You want to have a substantial stake and then add upon it when the conditions are right.
Well said. Well, let's say traders got in around the split adjusted 3 and it was around $30. If you look at this chart in mid 1990, we started to see a pullback. So from
Yep.
a split adjusted 15 down to less than 9. So how do you hold through that kind of pullback? Traders may have uh, gotten shaken out during that. So how do you avoid getting shaken out? Is it just the fact that you are buying right and sitting on a big
Yes.
gain and the fundamental story? I mean, you talked about the huge growth that this company was turning out during that time. Does that give you
Mhm.
the conviction to sit through a pullback like that?
It does. That's a great point you're making. And even though Home Depot had that amazing 4-year growth rate in the top and bottom line, it continued that, right? As I mentioned, according to their annual report, at the end of 1989, they only had 118 stores total. And you can imagine a company that's doing well is going to bound to be bound to double that. And so you keep an eye on that quarterly or annual report card given regarding the fundamentals in the business. Now, in the case of holding through that correction in 1990, great question, Ali, because I calculated a 40% drop from that peak around 15 to just under 9. That's actually pretty normal for a stock that has more than tripled. I've seen that in companies like Google after its IPO, in Cisco Systems, and we've seen that in Tesla and Nvidia in the current day, as well as Apple since the 2000s. So, of course, you have to expect some drawdown even in the best stocks. And if you prefer to avoid and sidestep that drawdown, then for sure, if you sense that the stock has made a short-term pop, has gotten to uh, uh, it's gotten way up too fast and it may be going vertical like what we see. I think if you look at that 1990 time period, yes, so there you go. You're drawing a upper channel that in which it crossed I think that was probably April, if not May. You can see that when you have a stock that's going vertical, that's usually a time to it's usually a time where you see stocks going to climax runs ahead of a bear market. Now, 1990, with the Persian Gulf War and the signs of a recession, the stock market anticipated the slowdown in the economy and the fear and concern regarding international conflicts, and therefore we had a decent bear market there. Decent, I mean, in terms of size, it was substantial. Probably, I'm going to say probably between 20 and 25% correction on the major indexes. So, as I said before, expect even the biggest winners to fall 1.5 to 2.5 times what the market does. And so that 40% decline is something that's not new. It happens over and over among these stocks. So you could certainly trim your position and
Mhm.
then,
Trade
or
around.
completely trade around it, but have your core position. Um, I I would really try to advocate those who find the right stock, the true market leader, to at least try to keep some of it because it keeps your attention, and it's very possible to miss the next move.
Right. Yeah, and again, we're not saying hold a stock down 20 or 40% from your initial investment, but draw a drawdown after a big move higher.
A
That
big
is
move,
totally
exactly.
normal to see that kind of base, and maybe you trim some, buy it back when it continues its advance. Now, Dave, I also want to ask you about when you do ultimately sell these things, because there are also countless examples of these true leaders that have, whether it's 3 years or 8 years of these impressive runs, but that doesn't mean we want to hold them forever, because ultimately there will be an end to the move. And then at
Hmm.
that point, uh, the move is over and you want to be
Right.
deploying that capital elsewhere instead of it being dead money, right?
That's
So
true.
how do we know how to finally get out when the time is over?
No one is gonna get out at the exact top, right? To the tick, to the penny. Is That's just a pipe dream. You just want to hope that you are fully exiting a stock after a long move pretty close. I mean, I've heard some professional traders say if you get out within 10 to 15% of the ultimate top, you've done very well. Consider this, right? IBD research found that once a true market leader has topped, the average drop is 72%. So if you nailed a fantastic stock and you recognize that maybe it's topped out and you're out at 10% or 15% off the top, that's a heck of a lot better than waiting for the stock to fall, 30, 40, 50, 70, 80, 90% off the high. One important tip would be keep an eye on deceleration in growth, year over year increases in earnings and sales. We really watch that closely. O'Neill had a rule where if you saw, I believe it was like a 60 to 70% deceleration in the year-over-year increases, like say from 100% profit growth down to 50 and then to 20 and then 10, that would be a concern for because you want to see a company able to consistently grow high double-digit rates after being at high throttle growth, 100%, 200%. Now, keep in mind that large and mega cap names can sustain big moves, just like Microsoft, and we'll look at that shortly, because they, despite being so big, they're still able to churn out 10, 12, 15% growth. Sometimes it slows down for a quarter or two, but the overall trend is really, really strong. Another tip would be obviously be very aware of those very, very big bear markets like the GFC of 2008, the 2020 uh, coronavirus bear market was short lived, but it was a pretty devastating one, and obviously the 2000 to 2002 dot-com bubble crash when things are too overly giddy and everyone is touting themselves as a stock market genius, then you want to be that contrarian investor and say, I think things are getting a little out of hand. I better take some profits and take the profits on the way up.
Right. I think also using longer term moving averages can also be your guide.
Oh yeah.
We didn't get a severe break in 1993, but we did get a close below a 24-month moving average, and then it went sideways for the next couple of years. Did of course launch another run, and we're still talking about Home Depot here, from the late 90s to the 2000 top, and then sliced below that 24-month moving average in a big way in October of 2000. Closed off of the lows for that month, but perhaps some of these longer term moving averages can help traders as well, Dave.
I'm so glad you mentioned that because I wanted to mention the technical aspects, but didn't want to get too heavy on that for this show. But in addition to what you're saying, I like to use that 24-month moving average for the stock price as well. You also have the relative strength line, which you have in green, and your big winning stocks are going to have that rising green line, that relative strength line, because it's outperforming whatever the S&P is doing on an up day or down day. You had that break of the trend, right, in the relative strength line around the time that the stock
Yeah.
peaked. Yep, and then also went below that key 24-month, which is 2 years moving average. So when you're breaking that, that means okay, something is happening that's different from the past 24 months in terms of price action and performance versus the general market. So I think that's a very valuable tool, and I'm really glad you've got that relative strength line there.
Yeah, definitely. Two key technical readings there on charts. Okay, let's go forward, but still in the past. We're going to go to Apple. And now I'm going to go to 10 years ago. So this chart is ending in 2013. And we're going to be focusing on the move that began here in Apple in 2003. So, kind of similar to Home Depot in the early stages of its growth story. Apple was not a new company in
Mhm.
2003, but it had a new product that really took off.
Oh, sure did, right? It wasn't the first smartphone maker, but it grew to become the number one smartphone maker, at least in certain markets. We know, of course, the Android phones are very very big around the world, and at the same time, Apple really overtook the BlackBerry. Research in Motion, which is now BlackBerry, was a hot stock in the early 2000s. But you can see in 2003 to right exactly to I think it was April 2004. That's when a base was setting up, and for sure, the stock was still well off its all-time highs. But we consider breakouts to 52-week highs as legitimate breakouts as well. There's a point in time where those past high prices become less relevant. Uh, so right there, exactly. That's a couple years into the incredible turnaround staged by the return of Steve Jobs as CEO. And then we also had new products, services. We had better performing MacBooks, you name it, right? There's just so many different products they created, and this was when we think about 10, 20 years ago, right? I think the smartphone was still pretty much a novelty in a way, right? Most of us had those flip phones, right, that just had limited functions. Now,
Yeah. And I think this wasn't the early 2000s. That was the iPod. Was really
yes,
starting
was
to gain popularity.
very, very popular, right? And we had the precedent of the Sony Walkman. I think Sony had some really, really big moves in the past because it had that amazing portable music player. And then Apple made it even better. You were able to store thousands of songs right on that iPod. You're absolutely right. And so it was just hit after hit, execution, global market potential, great brand, and institutional ownership that came in. You see on that monthly chart, everyone, especially from 2003 to 2005, you see those blue skyscrapers. Those are high volume months in which the stock was up for the month and the volume was also rocketing. There's no disguising of massive amounts of share buying by large institutions.
Definitely. Okay, and I'm afraid we're going to run out of time here. So let's get to today because I think we spent a lot of time on Home Depot because we went through all the different elements on the fundamental side,
Mhm.
getting in, holding, how long the move is and when to get out. So here's another example, Apple, we can apply the same analysis to. But what we're really excited about is to talk about today and what
Mhm.
are some of the potential game changing next 10 bagger stocks of today. And I think one key theme that everyone's talking about right now, Dave, is AI. It's no longer just a pie in the sky kind of thing, it's becoming real. And there's a real revenue component here that is starting to come to fruition for companies like Microsoft. So, talk to us a little bit about some of the stocks of today that we should
For
be
sure.
keeping a very close eye on.
I'll try to be as concise as possible here, but we've got that great daily chart that shows some of the fundamental data. On the top left corner, you can see that in fiscal 2023, which ended in June, profit of $9.81 was more than double than what we saw 4 years ago. So you can tell that that's a really strong growth rate, 21% over the past 3 to 5 years. We see that in earnings per share growth rate. No wonder Microsoft has a 97 EPS rating. And then you can see for fiscal 24, 25, 15% growth expected for one of the largest companies on the planet, 2.7 trillion. The reason why this is going up is because clearly the digital economy is growing. AI is a force, and they are investing big time in it. So we'll see whether they execute. We don't know that for sure. That's why the stock market chart is valuable for us, because it reflects the real time money decisions by millions of investors. So who can be smarter than millions of investors? Except that in periods of extreme greed or extreme fear. So right now, this stock, Microsoft, breaking out of a base, it is part of the leaderboard, the portfolio. I do actually I don't think I own shares because this is one stock I decide I'm going to be writing about this stock rather than owning it, so I can
Mm.
share IBD's analysis and knowledge about it. But for sure, I mean, if you invest in good mutual funds that focus on growth, more likely than not, it has it. I also
Mhm.
want to highlight two more things about Microsoft, and then we'll look at two others. It's amazing that the cloud computing phenomenon has been around for about 2 decades, and did you know Microsoft actually launched Azure 2008? So it's been 15 years. And Satya Nadella was head of the cloud and enterprise group before he became CEO in 2014. You can see that the 2014 move up until now has just been brilliant. Uh, basically a 30% CAGR in the stock price from the breakout in July of 2016 until July of this year, $56 to $366. That's almost a sevenfold move, CAGR of 30%. And Nadella becoming CEO in 2014 after success heading the cloud computing group. He became CEO at age 47. He was born in 1967, so he's 56. He's 56 years young. You got to think, hey, uh, you got to have good management and management that's very very energetic. That's another reason why I like Microsoft's prospects here.
Yeah, another key ingredient there. And guess what, Dave? This month, the stock getting back to new all-time highs. So that's very
Yes,
impressive. This is
very
this is
impressive.
leading the market rally right now.
It is, absolutely. A couple other names that we're going to look at very briefly are Cadence Design, CDNS, and MedPace, MEDP. These are the two final tickers we'll talk about. These two have something in common with Microsoft, and that is they are members of the IBD long-term leaders list. If you are an IBD subscriber, you can go to stock lists on our main navigation bar on investors.com, and then you can look at the 10 or 12 names in the long-term leaders. All three of these, CDNS, MEDP, they really show amazing growth metrics. I also want to highlight that in terms of MEDP, they CFO had announced really strong outlook for earnings, $5.10 a share for the year. Non-GAAP margin, operating margin is going to be targeting 41.5% to 42%. I believe that's for the fourth quarter. And the company says this is Cadence Design in the chip design area, that they plan to use at least 50% of their free cash flow to repurchase shares. This is one thing that I forgot to mention, Ali. We didn't even talk about it during the pre-show huddle, but one common thread, perhaps among the greatest companies that give you that 5, 10 bagger kind of move, is that the companies dine on their own cooking. In other words, they buy back their shares. They don't simply pay a dividend, but they buy back their shares to reduce or control that diluted share count, which helps them bring stronger earnings for shareholders.
Mhm. That's a really great point there too. So whereas Microsoft may still be actionable in terms of the buy zone. Cadence is getting a little extended here. So perhaps traders should wait for a gentle pullback. This one does have a personality where it will pull back to the 10-week line.
Exactly. That's one of the things we write about in the weekly or biweekly column of the long-term leaders. Not just a list, but just the sort of content in the story is that we prefer that you get in at a kind of a so-called discount to the price, and that's exactly what mutual funds do. They wait for those pullbacks to either the 10-week or even the 40-week moving average. They kind of run tantamount to the 50-day and the 200-day lines on the daily chart. And so if you're a fund manager and you see the stock, a great stock coming back to the 200-day moving average, in other words, you're buying that shares at an average price over the past 10 months. That's a pretty good area to buy.
Hmm. So, looking at MedPace here as well, it looks like it's on the verge of a breakout area and relative strength line looking pretty bullish there, underscoring the price outperformance and then the volume. You're talking about institutional involvement that shows up in the volume in these charts, Dave. So,
It
thank you so
does.
much. So, 3 stock ideas here potentially. And of course, we have to say that stock ideas come from a lot of research, but ultimately, no one has a crystal ball. So, following rules and getting out if your thesis doesn't align with what is actually happening in the chart, or maybe your timing was off. But, like Dave said, try again if it sets up again. So that way you can try to get one of these 10 bagger stocks. Dave, before we sign off, can you just repeat the other stocks on that screen that you talked
Yes.
about? Someone was wanting a repeat of that to write
Ha
those
happy
down.
happy to do so. And as I said, if you have your own kind of screening tool, look for those companies that can grow earnings per share 40% year over year for at least 3 quarters, have strong sales growth, as we mentioned, an SMR rating of A or B, and also have a return on equity of 25% or more, 25% in the latest year, not quarterly, but latest year. And so the 4 companies that popped up on the screen were CRWD, KNSL in insurance, NOW, and ZS.
Great. Thank you, Dave, so much. Great discussion.